China has been the global economy's growth engine. However, recent events in the Chinese economy have sparked doubts and anxiety among investors in countries worldwide. Will the Chinese slowdown affect other global economies? Is there a possibility of a domino effect? Let's see. China is experiencing a significant debt crisis in its real estate sector and an economic slowdown. The economic crisis has severely damaged major developers, discouraged investors, and sparked worries about potential widespread economic fallout. The effects of China's economic slowdown are not limited to the nation. Rather, they are having unanticipated repercussions in remote reaches of the European high-yield credit market. While President Xi Jinping considers unusual policy moves, including raising the budget deficit, which was increased to its highest magnitude in 3 decades, there are a number of unanswered questions regarding the state of the Chinese economy at the moment. The nation broke with its traditional framework for fiscal support when it unveiled a sovereign debt package. In October, the nation's deflationary pressure reappeared, raising concerns about the pace of the economy's recovery. According to data released recently by the National Bureau of Statistics, consumer prices fell by 0.2% last month after hovering at zero for the last 2 months prior. Additionally, producer pricing levels fell 2.6% in October, marking the 13th consecutive month of declines. According to Bruce Peng, chief economist for Greater China at Jones Lang LaSalle Limited, combating persistent disinflation amid weak demand remains a challenge for Chinese policymakers, said Bloomberg. To prevent the economy from a downward drift in inflation expectations that could threaten business confidence and household spending, an appropriate policy mix and more supportive measures are needed. Despite a slowdown, the future of the Chinese economy doesn't look very bleak. Recently, the International Monetary Fund forecasted 5.4% growth in China's economy this year. This was an upward revision from an earlier forecast of 5%, as the IMF believes that the Chinese economy has made a sharp post-COVID recovery. We have revised up growth by 0.4 percentage points in both years relative to our October WEO projections, reflecting stronger than expected growth in the third quarter and the new policy support that was recently announced, IMF's first deputy managing director, Gita Gopinath, said in Beijing. Local government debt risks continue to remain high in China, reaching $12.6 trillion. This is 76% of China's economic output in 2022 and a significant increase from 62.2% in 2019. The government claims to be working to resolve the issue of high local debt, and the IMF has also recommended a comprehensive restructuring strategy. The central government should implement coordinated fiscal framework reforms and balance sheet restructuring to address local government debt strains, including closing local government fiscal gaps and controlling the flow of debt, Gopinath stated. China's investments in fixed assets decreased at their slowest rate since 2020 during the first 9 months of 2023. The expectation among investors was that the relaxation of COVID-19 rules would stimulate strong economic growth in the second largest economy globally. Contrary to predictions, though, protracted economic stagnation and rising U.S. political tensions are leading to poor returns and a sense of uneasiness about what lies ahead. Xi Jinping, the president of China, has outlined a number of initiatives to revive the flagging economy. Along with revealing the biggest headline deficit in 30 years, the government signaled a shift from its traditional fiscal support strategy by introducing a sovereign debt package. The addition of $137 billion to the budget and the readiness to go above and beyond the traditional 3% threshold for the deficit to GDP ratio demonstrate Beijing's unwavering commitment to accelerating growth in 2024 and avoiding complacency. It looks like China is not only facing a domestic debt crisis, but also creating a debt trap for other countries. Let's take the example of the latest victim, the Maldives. The Maldives, a strategically located country in the Indian Ocean that has switched allegiances from India to China and borrowed excessively, is in great danger of debt distress, the IMF warned on February 7th. Since pro-China President Mohamed Muizzu came to office in November, Beijing has increased its financial commitment to the Maldives. Following a visit to Beijing last month, Mr. Muizzu commended China for its selfless assistance in financing development. The IMF did not disclose the Maldives' foreign debt, although it was said that urgent policy adjustment was required. Without significant policy changes, the overall fiscal deficits and public debt are projected to stay elevated, the IMF said after a review of the country's economy. The Maldives remain at a high risk of external and overall debt distress. Known for its white sand beaches and with tourism making up about a third of the economy, the archipelago has recovered financially from the COVID-19 pandemic. Although an expansion of the airport and more hotels are expected to spur GDP, the IMF said that uncertainty surrounding the outlook remains high and risks are tidal to the downside. The mentor of Mr. Moizu, former President Abdullah Yameen, drew significantly on Beijing's construction projects throughout his 5-year rule till 2018. Based on information from the Maldives' finance ministry, the World Bank said that in 2021, the country owed 42% of its total foreign debt of about $3 billion to China. The problem is that growth is stagnating after a sharp uptick in activity earlier this year when the COVID lockdowns were lifted. Exports are struggling, consumer prices are declining, and the real estate crisis is becoming worse. Youth unemployment has gotten so terrible that the government no longer publishes data. Worse, two well-known homebuilders and investment firms have stopped making payments to their investors in recent weeks, which has stoked concerns that the further decline in the housing market may increase threats to one's capacity to maintain a stable financial position. A new wave of growth downgrades has been sparked by fears of contagion and a lack of decisive steps to boost domestic demand. Multiple major investment banks have lowered their estimates of China's economic growth to below 5%. We reduce our expectations for China's real GDP growth. UBS analysts said in a research note on Monday that as the property downturn has deepened, external demand has weakened further and policy support has been less than expected. Previously, researchers at Barclays, Morgan Stanley, and Nomura had reduced their projections. This implies that China may fall well short of its stated growth objective of about 5.5%, which would be embarrassing for President Xi Jinping's administration in China. That is a far cry from the global financial crisis of 2008, when China was the first major economy to emerge from the crisis and implement the world's largest stimulus plan. Additionally, it's a turnabout from the early stages of the pandemic, when China was the only significant industrialized nation to escape a recession. So, what's gone wrong? After the year's early momentum waned in April, China's economy has been in a slump ever since. However, worries have grown this month as a result of defaults by Zhongrong Trust, a reputable trust organization, and Country Garden, which was formerly the nation's largest developer by sales of real estate. Investors were alarmed by reports that Country Garden had neglected to pay interest on $2 debts. This reminded them of Evergrande, whose financial defaults in 2021 marked the beginning of the real estate crisis. Evergrande is still undergoing financial reconstructing, but Country Garden's problems have raised new concerns about the Chinese economy. Beijing has implemented several encouraging policies to boost the property market. However, the fact that the even more powerful parties are currently on the verge of default highlights Beijing's difficulties in controlling the situation. The nation's $2.9 trillion investment trust sector appears to have been affected by debt defaults at real estate developers in the meantime. According to business disclosures from earlier this month, Zhongrong Trust, which oversaw $87 billion in assets for wealthy people and corporate clients, has not paid back a number of investment goods to at least 4 companies, totaling $19 million. CNN showed recordings from Chinese social media that showed angry protesters even blocking the trust company's headquarters and demanding payouts for high-yield items. More losses in the real estate market could lead to broader financial instability, stated Capital Economics' head of China economics, Julian Evans Pritchard. More non-bank financial institutions may experience liquidity issues as domestic funds increasingly migrate to the safety of government bonds and bank deposits, he continued. Another significant issue is the rising debt of the local government, which is mostly the result of the property slump's severe impact on land sale revenues and the ongoing expenses associated with enforcing lockdowns throughout the epidemic. In addition to posing significant risks to Chinese banks, the acute budgetary strain observed at the local level limits the government's capacity to promote development and enhance public services. To date, Beijing has launched a slow but continuous stream of economic stimulus packages such as loan rate reductions and other initiatives to support consumer firms and the real estate sector. However, it hasn't taken any significant actions. Economists and analysts have informed CNN that China can no longer stimulate its economy as it did during the global financial crisis 15 years ago because it was too leveraged. In an effort to lessen the effects of the world financial crisis, Chinese officials at the time unveiled a $586 billion fiscal package. However, the policies, which were centered on infrastructure projects run by the government, also brought in an enormous rise in local government debt and an unheard of credit expansion from which the economy is still recovering. That's all for now. Thanks for watching. If you enjoyed this video and found it informative, don't forget to hit that like button below. And if you want to stay updated with more great content like this, make sure to subscribe to our channel by clicking the red button and ringing the notification bell so you never miss any future content from us.